Hi, everyone. Coinbase Institutional is proud to present another installment of On the Record with me, John D'Agostino. I'm here today with Sebastian Bea, the president and CIO of ReserveOne. Thanks for coming, Sebastian.
Great to be here. Great to see you.
Good to see you. Now, ReserveOne is, upon closure, is going to be a diversified digital asset treasury firm. And you've been very vocal about the importance of yield-bearing, diversified digital asset treasury firms. So walk me through why that's so important.
Well, similar to Coinbase, we're focused on the client and the next wave of capital to bring into the crypto ecosystem, right? And our view is that this next wave of capital needs a slightly different, or actually in our case, significantly different package of tokens and strategies to bring in that next set of, let's say, probably older, more experienced, more conservative investors, right? And those investors in general, we could categorize that as, the clients of registered investment advisors in the United States of America. They don't want to sift through a Bitcoin DAT, an Ethereum DAT, a Solana DAT, or name your token. In their world, they buy diversified exposure, right? And they haven't done almost anything here. So the first step for them is actually, we think, going to be something that embraces diversification. So that's one of the biggest drivers. We think that to build this next bridge, the bridge has to look a little different.
So a big part of your strategy is yield generation. Now, you can't get yield without taking some degree of risk. How do you think about risk management, particularly as a public company, as it relates to yield generation?
Great question. Risk is very important. But yield is actually a function not only of risk, but also illiquidity. One of the benefits of being a digital asset treasury as compared to an ETF is that we actually, as a permanent vehicle, have much more liquidity that we can take advantage of. And that's another way by which we can actually lean into these assets, lean into the ecosystems to generate more yield. If you want to make yield, but only are going to lend for a day, that rate is pretty low. If you're willing to lend your token for a month or 6 months or a year, and this is just the lending market, for example, those rates increase with the amount of illiquidity that you're willing to take. So it's really important to understand that, yes, there's obviously risk whenever you're deploying your assets to seek yield, but one of the dimensions where you can seek yield and not take more risk necessarily is through more illiquidity. Now, to more directly answer your question on risk, the risk curve in crypto is a little bit different than it is in the traditional financial system. In traditional finance, if you want to get higher yield, and eventually what sometimes people refer to as fool's yield and high yield, you're taking increasingly poor credit quality, right?
Right.
In the crypto ecosystem, it's actually a little bit different because in general, as you go further out the risk curve, you tend to take more complexity risk. Meaning, are you going to engage in DeFi, right? And what are the issues that come there? That's not a credit risk story. That's actually more of a protocol risk story. Is your protocol that you're using, can it get hacked, right? Have you done a smart audit, a smart contract audit? There's other issues the further out the curve that you go, but that's maybe at a high level how we think about it.
So you've outlined duration risk. You've outlined, I think as you elegantly call it, complexity risk. What about geography? Are you able to access yield from outside the U.S. or is it mostly internal to U.S.?
Well, this is a great question, and actually there are no great answers as to what a U.S. entity can or can't do past its borders in certain dimensions. Now, specifically, this is in DeFi, right? Which DeFi operates outside of all borders, but in reality, we are still bound by the laws and the regulations of the U.S. and things like the Bank Secrecy Act, AML, KYC. So in this instance, the risk here that we're trying to think through is, can we deploy our assets in certain pools when, and the question there is are we confident that we can follow the rules around AML, KYC to ensure that we are not engaging in anything that would be close to being viewed as money laundering? This is a key question that's still basically unresolved. More recently, the Treasury issued an RFI that was due October 17th of this year, specifically asking the community, saying, how can we detect illicit activity on blockchains, which is another way of saying, how can we enable institutional usage of DeFi. Now, that's exciting because they're engaging, but it's also telling you that the roads are not clear, right? And so we have to engage, we have to study it, but we have to be very careful when we deploy our assets because some of the rules are not written yet, and we have to make sure we don't end up on the wrong side of where rules end up getting written.
I'll ask you the same question I asked our last guest, who was an attorney, so a bit unfair, but you seem very on top of these emerging rules. Are there rule clarifications, laws? What are you excited about? What are you looking for in the next year to 18 months that'll make that path clearer?
So at a high level, we expect that we're likely to end up with some sort of technology solution and, let's say, law that ratifies that technology solution as being sufficient to comply with AML KYC. That would unlock massive growth for DeFi protocols. It's been talked about in the industry, this DeFi mullet, right? Or CeFi DeFi, a centralized entity like a Coinbase at the front, and eventually these permissionless protocols like a Morpho on base in the back, right? This is in many ways probably the future, right? But we need to hear, and I think we will eventually hear from Treasury and other kind of related entities, exactly how we can use privacy protecting technology to still to attach to our anonymous wallets such that we can engage in this permissionless DeFi technology, but not fall afoul of rules, because all the entities can say, well, I don't know who that person was, but I do know that I was not doing something with an illicit actor, right? That technology solution where you can prove that this person or this entity is clean from an AML KYC perspective, that is coming, and that could make TVL and DeFi, which is only like 150 billion, give or take. I mean, we could see that 10x to 100x because traditional finance could then migrate onto these rails.
I mean, it's a problem. There's no question. I can't help but think, though, we've seen this problem. It's not completely new in that, my background's in commodity markets. So there's a spot listed commodities market, and then there's an OTC market, which is sort of like DeFi, peer-to-peer, effectively, and it dwarfs the listed market. So there's other markets that have less OTC markets that are more difficult to track down provenance and ownership, that are multiples larger. So hopefully, and they're not banned, they're not restricted, and institutions play extensively in the OTC commodities markets. So hopefully we'll get to some thoughtful place where just because it's crypto, it doesn't mean that institutions have to be frightened of the consequences of engaging in the equivalent of an OTC or peer-to-peer transaction.
Well, I agree, and I'll just add on to that. Look, it is coming. It's coming fast, right? So in perpetual futures trading in the world, Hyperliquid is taking about 10% of the market in 2 years. This is a very big deal. We're seeing a very quick migration from centralized to decentralized in terms of getting things done. So I think the reality is that Washington, D.C. has to engage because it's kind of happening either way. But ideally, it can happen in a way where the U.S. reasserts its leadership and dominance in finance because they've earned it. And now this is a set of tools that basically need some help. And if the U.S. does the right thing, then we can really help it emerge in the right way.
Your team, board and management company, represent a blending of traditional finance. I'll point out, because I know your team well, the highest levels of traditional finance and the highest levels of native crypto. How does that give you an advantage?
It's a great question. If I think across the entire team, we have this unique blend that I think will help us be that new bridge that's needed for like the next cycle of digital asset treasuries. Like what's happened thus far has been single asset digital asset treasuries. But as we were speaking earlier, that has only brought in so much capital, right? How do we unlock the rest of this ecosystem to the broader market? It probably means that the makeup of the team and the strategy has to be substantially different. So I think when I look at our team, whether it is our crypto knowledge or our traditional markets knowledge, I think those two things bookend this transition that's occurring, right? And so we really, I think, are best positioned for like the next big wave because we have a better sense of what traditional finance really needs, right? given our traditional finance experience, but we also have a native understanding of what is happening and what it's going to take to bring those opportunities to a traditional environment. So maybe it's just basically summarizing, we understand both of these worlds probably in a unique way.
I mean, DATs have been extraordinary, but I don't think anyone had former Commerce Secretary Wilbur Ross and a co-founder of Tether on their bingo card, being on the same board. It's a real achievement.
Well, I think maybe to better answer your question, the existence of ReserveOne and what we're seeking to build right now, and the team that we put together is a sign of the times, right? That the time is now for crypto because it's actually becoming real in the real economy, right? It is actually changing how people save, right? Bitcoin. It's actually changing how people spend, stable coins, right? And it's going to change how people invest with tokenization. Those two things have already happened, and the third one is right around the corner, right?
Right.
And now, how does that really happen at scale? Where you're going to have a different team, and that's what we have.
Sebastian, institutions are piling in, but they're new. So they have misconceptions. What is the biggest misconception that you've seen institutions have about achieving yield in digital assets?
So yield in crypto is fundamentally different than yield in traditional markets. And it takes a little while for institutions to really understand this. Because crypto still today is an early asset class, right? The general source of yield has been basically traders borrowing to speculate in crypto. Now, what does that mean? That means that yield performs very differently in crypto than it does in TradFi. Meaning, simplistically, if Bitcoin is up and going up fast, more people want to buy it, and so yields go up. So assets up, yields go up. Bitcoin down, yield down. This is the opposite that we as compared to traditional finance.
Sure.
If S&P 500
Prices
gets
up,
hammered,
yield down, yields down, prices up.
well, so if the S&P 500, a risk asset is under a lot of pressure, what happens to high yield spreads? They blow out.
Wow.
So an investor who's buying those bonds at that moment is getting a higher yield when risk is for sale. Here, yields go higher when risk is being bought, and yields go lower when risk is being sold. This is the inverse of traditional financial markets. Now, why is that helpful? Because yield investors can actually find an uncorrelated yield source in crypto. Because when markets are going up in traditional markets, there's no yield to be had in traditional markets. But over here, there is, right? So there's a portfolio statement around crypto on the yield side that still traditional investors are waking up to.
Sebastian, what will signal to you that diversified yield-bearing digital asset strategies like ReserveOne have truly gone mainstream?
Well, when we have more copycats. Right now, we've just gone through the capital market, the capital raising process. And as it stands today, based on the information that we have, we believe to be the only scaled digital asset treasury that's expected to launch relatively soon. Now, we like being early, we like being different, right? But that doesn't tell us that the market has necessarily come around to us as of yet, right? What we would expect is as we get more legislation passed, specifically the Clarity Bill in DC, and then we get clarity as to how these assets are treated, that will drive a lot more willingness of investors to invest across a broader kind of range of assets. And then that would then make it easier for investors to look at a platform like ReserveOne, which we are building. To date, you've really had clarity in Bitcoin, right? And somewhat in Ethereum, but that's been, either forced through law, through a court or through a political process. We haven't had a legal process that is now created new regulations and made things clear. That's likely to happen, we think, next year. And that's likely to drive, we think, more investors to demand diversified portfolios and more people competing in our space.
Thank you so much, Sebastian. Great having you.
Great to see you.
Cheers.